A stock moving 16% in a single trading session is not normal, even by 2026 AI hype standards. Supermicrocomputer did exactly that today, and the reflexive reaction from most retail investors will be one of two mistakes: either chasing it because it moved, or dismissing it because it already moved. Both are wrong. The real question is what specifically caused this, whether the underlying business actually justifies that repricing, and what this single data point tells you about where the AI infrastructure trade stands right now. That is what we are going to work through. Let's establish the facts before we editorialize. SMCI's 16.1% move on June 27, 2026 came on volume running roughly 3 to 4 times its 90-day average daily volume. That is not a quiet drift. That is forced repositioning by institutions that were caught offside. The catalyst almost certainly traces to one of 3 things that have been driving violent repricing in AI infrastructure names all year: a major contract announcement, a guidance revision tied to hyperscaler capex, or a short squeeze compressing against a genuine fundamental update. In SMCI's case, the company has been a direct beneficiary of the build-out of GPU-dense server clusters for large language model training and inference infrastructure. When hyperscalers, your Microsofts, your Amazons, your Googles, revise their CapEx guidance upward, the downstream server ODMs, like Supermicro, see it in their order books almost immediately. What the market does on a day like today is essentially a re-rating. It is repricing the probability distribution of SMCI's forward revenue. Here is what a beginning investor must internalize. A 16% single-day move almost never represents 16% more intrinsic value appearing out of thin air. It represents a rapid consensus shift, the crowd changing its mind fast. The actionable insight here: before you act on a move like this, identify which specific information changed and whether that information is durable. A contract win is durable. A short squeeze on thin news is not. Those 2 scenarios require completely different responses. Here is where we separate the people who understand markets from the people who just watch price. A 16% move sounds large in isolation. Whether it is justified depends entirely on SMCI's valuation framework going into today and what the catalyst implies for forward earnings power. Supermicro has historically traded at a revenue multiple that reflects its position as a high-volume, relatively thin margin hardware integrator. That is the structural tension in this story. The company sits at the center of the AI infrastructure boom, but it is not capturing value the way a software company would. Its gross margins typically run in the 14% to 17% range. Compare that to NVIDIA's 70% plus gross margins, and you understand immediately why SMCI can have explosive revenue growth and still get valued conservatively by the market. So when SMCI moves 16%, you need to ask, did something change structurally about margins, or did revenue visibility just increase? If it is purely a volume story, more servers shipped, same economics, the market may be temporarily overpaying. If the company is demonstrating pricing power, moving up the stack toward higher margin liquid cooling or custom rack solutions, that is a genuine re-rating catalyst. There is also the short interest dimension. SMCI has historically carried elevated short interest because its accounting saga from 2024 left institutional skeptics in the stock. A positive fundamental surprise hits shorts directly. They cover, which mechanically amplifies the move. That amplification is not new value creation. It is just price mechanics. The actionable insight: decompose any large single-day move into its fundamental component and its technical component. The fundamental component is what you own going forward. The technical component is noise that can reverse just as fast. Not financial advice, but knowing that difference is foundational to not losing money on momentum chases. Moves like SMCI's today are one of the best classrooms in markets, because everything gets compressed and visible in real time. Let me give you 3 specific lessons that apply far beyond this one stock. First, volatility is not randomly distributed. SMCI is volatile because it sits at the intersection of genuine secular demand, thin margins, a complicated recent audit history, and high institutional short interest. Each of those factors individually creates variance. Together, they create a stock that can move 16% in either direction on a meaningful catalyst. When you own high volatility stocks, you need to size accordingly, meaning smaller position sizing than you instinctively want when the thesis feels compelling. Second, the AI infrastructure trade in 2026 is not monolithic. NVIDIA is not SMCI. Arista Networks is not Vertiv. Each company in this supply chain captures value differently, faces different competitive dynamics, and deserves a different valuation framework. Treating them as a single trade because they all have AI somewhere in the pitch deck is how you buy high and sell low across an entire sector. Do the disaggregation work? Third, days like today test your process. If you owned SMCI before this move, what do you do now? If you did not own it, should you enter? The answer in both cases is not emotional. It is process-driven. Revisit your original thesis. Ask whether the catalyst that moved it today changes your 12-month or 24-month view of the fundamentals. If yes, the new price may still be justified. If no, the stock just handed you a gift in the form of a better exit price or a clear signal to stay patient on the sideline. The investors who build real wealth from individual stocks are not the ones who caught the 16% day. They are the ones who had a thesis before it, sized it intelligently, and made a calm decision after. That is the entire discipline, compressed into one session. We open by asking whether today's 16% move in SMCI was something to chase, ignore, or study. The answer is study. Because the mechanism behind it tells you everything about how AI infrastructure names get repriced in real time, and what separates a durable catalyst from a one-day technical flush. The follow-up question we're thinking about: if hyperscaler CapEx keeps expanding through 2026, which company in the AI supply chain is actually positioned to expand margins, not just revenue? That is the next video. Subscribe if you want that analysis when it drops.